Fans all back together again. So, Mike, let's start out with the implied moves you're seeing in some of the names reporting next week.
Yeah, so take a look at Best Buy. That one's implying a move of just under 6%. Foot Locker is the one that's really expecting a big move. That one's expecting a move of almost 18%. If you remember last quarter, it really took a beating. Ulta implying a move of about 6%, and Costco a much more modest, and it doesn't typically move that much, 4%.
All right, but we do want to focus in on Dell here, since NVIDIA was a big headliner this week, and all eyes are on the next AI play. So, Carter, what do the charts say here on Dell?
Well, let's go with the word full again, because expensive is unknown, right? Valuation is one of the worst timing tools in the history of markets. But if you look at this chart, this is a weekly bar chart. We're at the upper band of this well-defined channel in which we've been ascending. Let's just zero in a little bit and look at the daily chart just to put this in relief. And what you'll see here, again, is that we have ricocheted off the bottom end of the channel perfectly to the penny over and over, and now we're at the top of the channel. Interestingly and curiously, Wall Street, in their infinite wisdom, has a price target of $142. It's trading $160. That means Wall Street thinks it's going lower, not higher, in the next 12 months. But I think it's full. I would sell, write calls, do something.
What are your thoughts on Dell, Mike, and what's your trade here?
Yeah, I mean, obviously it's had this huge rally. I think some of that rally has been prompted by folks' enthusiasm, perhaps that they would be a beneficiary of, the big push for data centers, and that would help their server business at least, and some other areas haven't been doing that well. As Carter points out, of course, taking a look at the fundamentals, what we're really going to end up finding out is whether or not that optimism was well justified. Right now, the options market is implying a pretty big move, about 10% higher or lower after they report. And of course, that's not surprising when you consider that 4 of the last 8 quarters they've seen double-digit moves. So taking a look at a move lower potentially, but trying to look at a trade where I wouldn't lay out any premium, I was just looking out to the weekly 152.5, 145. 1-by-2 put spread. So buying one of the 152.5 puts and selling 2 of the 145s against it. The peak profits for that trade, which would actually require no outlay of premium, would take place at that lower strike, which coincidentally happens to be not far off of the Wall Street price target, and also pretty much spot on that 10% implied move to the downside. And if you just take a look at the fact that the thing is still trading, in the teens, I think, in terms of its multiples at the moment at least, that's probably as much of a downside move as I might expect.
All right. So Dan, what do you think of Mike's effort to risk less and make more?
There you go. Listen, we kind of give these disclaimers all the time. Naked put selling, naked call selling. I mean, that's kind of deep end of the pool sort of stuff. So Mike is constructing a trade targeting that 10% implied move, and it makes perfect sense if it gets there, but not if it goes too much lower than. Listen, you have plenty of room to the downside, but just understand it takes a lot of margin in your account to do that. So I like the trade if you're a semi-pro.
All right.